Now we are going to start final accounts. Before I start final accounts, you must know the features of final accounts. Actually, final accounts are always prepared on the basis of trial balance. You know, trial balance is the list of closing balances of different accounts. And final accounts are sometimes called financial statements. Actually, financial statements or final accounts take us to the profit position or loss position of the company, means what the company has made profit or suffered loss during the year. And secondly, final accounts take us to the financial position of the company at the end of the year. You know, balance sheet always tells us about the financial position of the company. What is financial position of the company? Financial position means the position of assets and liabilities. So, final accounts will be having two parts. Number one, income statement. Number two, balance sheet. Income statement will tell us about the amount of profit made by the company during the year, and balance sheet will tell us about the position of assets and liabilities. You have already learnt about the balance sheet in our previous segments. And before I start final accounts, you must be aware about the types of expenses. You know, now you are familiar with the expenses like wages, salary, fuel, carries inward, carries outward, bad debts, loss by fire, loss by theft, etc., etc. And we have used these accounts in our previous segments. All these expenses and losses can be categorized into two parts: direct expenses or indirect expenses. Direct expenses are those expenses which are related to, I mean to say directly related to production. And other expenses are called indirect expenses. To make it more convenient, I can say the expenses incurred up to the door of the factory. Suppose you are running some factory, you are publishing books, or you are making bread and biscuits in your factory. All expenses and losses up to the door of factory when the goods are ready, up to that point, the expenses are direct, and after that, all expenses are indirect. For example, you are paying wages in your factory to the labor. They are direct expenses because the goods are not yet ready. If the goods are ready, means ready to sell, ready to be sold, and after that all expenses are indirect expenses. And let me explain again, all expenses are of two types: direct expenses and indirect expenses. And under the category of indirect expenses, we cover selling and distribution expenses, and number two, financial expenses. Selling expenses, suppose carries outward, you have paid advertisement, the cost of the samples, etc. And financial expenses, suppose you have paid the rent of the office, electricity bill, salary to the staff. And third category is office and administrative expenses, means any expense related to your office or administration. All expenses are indirect expenses. Salary to the staff, electricity of the office, fuel of the cars, manager's salary, rent of the office, etc., etc. So in indirect expenses, we cover selling and distribution, office and administrative, and financial expenses. But in the direct expenses, they are directly related to production, like wages in the factory, fuel. Sometimes we have to use some fuel in the machinery maintenance in the factory. If you are paying power in the factory, means power is always used for the machinery, not for the office. So power is always treated as direct expenses. Carries inward, because when you pay the carry inward, basically you are paying carries on purchases. It means the goods were not yet produced, because I have already told you the expenses incurred after production are called indirect expenses. So carries inward is a direct expense, but carries outward is a indirect expense. One thing more, I have already told you that final accounts will be having two parts, income statement and balance sheet. And income statement will be having two parts, trading account and profit and loss account. So we can say that final accounts are in three parts: trading account, profit and loss account, and balance sheet. Because in final accounts, we don't jump to the net profit directly. We reach net profit via gross profit. In between, we calculate one more stage, and that stage is called gross profit. And whenever we make the final accounts, I mean to say trading account, profit and loss account, and balance sheet, we always write down trading account for the year ended, because in our question, the year ended will be 31st March 2013. So we'll write down trading account for the year ending 31st March 2013 or for the year ended 31st March 2013, and profit and loss account for the year ending 31st March 2013. But when we make the balance sheet, we always write down balance sheet as on 31st March 2013, because balance sheet is the position on a particular day. But trading account and profit and loss account, they include the transactions of the year.